How are you guys doing? This is Ryan, welcome back to the channel. In this week's video, we're gonna talk about the 4 stocks I am buying in the month of August in my $76,548.70 Robinhood portfolio. I've been building this portfolio for just over a year here on YouTube, and I own like 25 to 30 stocks within the portfolio, but that does not mean I'm always buying every stock. And certain stocks pique my interest at different times, and every once in a while I'll add a new stock and I'll get rid of a stock, all depending on my outlook of that company moving forward. But there were 4 stocks that really piqued my interest that I actually purchased this last week. A few of them were around earnings, and another stock I'm just amazed at the concept, and I had to become a shareholder. I'll share all that in this week's video. So with that said, let's jump into it. Alright guys, quick disclaimer, this is not financial advice. This video instead is for entertainment and education purposes, and me just documenting my own personal experience on my investment journey. And if you enjoy content like this, please make sure you subscribe to the channel, give the video a thumbs up, it greatly helps this channel reach a broader audience. So I'll keep those disclaimers short, but let's jump into these stocks. The first company I've been buying this month in the month of August is actually a company that recently IPO'd and actually made major news because the stock went up a lot after it IPO'd, and that is Lemonade. Lemonade is an insurance company based on technology and behavioral economics. Now, like a lot of IPOs, it shot up out of the gate like a Facebook or a Uber, and then it kind of nosedived back down. Once it started going back down, I got so excited and I started buying at all different prices. I bought in the low 80s, I bought in the 70s, I bought in the 60s, and I bought in the 50s. So I've chased this thing all the way down because this stock is very difficult to price because it's such a new, innovative idea. And you can't measure a stock like this like on current earnings and how much market share. But let me briefly explain the concept and why I like it so much. Insurance is all about pricing risk. And insurance companies like Aflac, MetLife, State Farm, Travelers have been around for over a century. And the dynamics of an insurance company is very interesting. They're not incentivized really to pay you out claims. And a lot of the times the idea of filing an insurance claim seems like a headache, a lot of paperwork, a lot of fine print, and the insurance company actually has a vested interest in not giving you back your money. Lemonade actually flipped that concept on its head. They said, no, we're gonna take a flat fee and instead excess profits go to a charity of your choice, which is very interesting. So therefore the insurance company is actually not disincentivized to give you your money. And actually Lemonade is paying out insurance claims in seconds, roughly about a third of them. They use algorithms and Autobot technology, but also they believe that consumers are unlikely to embellish claims if that money is going for a non-for-profit. Now, I don't know if all this is true, but the thing I'm really looking at for the company is their relative market cap and what they could possibly grow into. Because I believe that their concept is so much better than what we currently have in the market today, and this can really be disruptive to the whole insurance business as we know it. In the first quarter of this year, they actually did about $26 million in revenue, but the company's valuation is over $1 billion, but they're tracking over 138% year over year in growth. So the company's total market cap is just shy of $2 billion. But when I go look at other insurance companies like MetLife and Travelers, well over $25 billion. So using those investing metrics, I really believe that MetLife is a 10x potential type investment, and I just can't miss out on an opportunity like that. A fast growing company that has such a better idea. And I really like the company's leadership. I really suggest listening to both their CEO and their behavioral economist. That's Daniel Schreiber, their CEO, and Dan Ariely is their head behavioral economist. And I believe will become massive. They're not available in all of the country, and they're only offering a few different types of insurance so far. They're really trying to attract the millennial. Everything is based on an app, and they're starting off with the millennial moves out of mom and dad's house and they go rent somewhere, and then now they need renter's insurance. So that was like the first thing that they offered. And then that millennial gets into a relationship, and then they get a pet, and maybe you need pet insurance. So they offer pet insurance. And now that millennial has worked at his job, saved up enough money to buy a home, and now that millennial might need homeowner's insurance. I don't know if I see a lot of people in their 60s and 70s really transferring over to an app-based insurance model, but I can tell you that this is something that would be very attractive to someone like me, or my younger brothers, or other people I know. So for all these reasons, I'm very bullish on Lemonade, and I've been buying it the whole way. And I've currently bought 24 shares at a dollar cost average of $73.19. All right, now the second company I've been buying this month is actually a very different company than the first one. Rather than a new innovative idea, it's a company that's been around for 140 years, and that is Leggett and Platt. Leggett and Platt. Leggett and Platt is a company that is in your house and you probably don't even know it. They specialize in thousands of products that are merely components that are engineered in things like mattresses, chairs, all types of furniture, vehicles, and even items in aerospace. They are so intertwined in so many aspects of the economy. This has allowed them to sustain 140 years in business and 47 consecutive consecutive years in dividend growth. So for me, this is a dividend play. And I first started buying the stock when it crashed all the way from the mid-50s into the mid-20s, and now the stock has gone up back into the high 30s. And they reported earnings this week, and they sold off really hard on earnings despite outperforming their earnings. They reported a profit of 16 cents per share when the expectation was only 7 cents per share. So given their outperformance and the stock selling off, I said it's time for me to buy some more Leggett and Platt. I bought more at $38, and that locked me in a starting dividend yield of over 4%. Now the stock rebounded a little bit more. So the stock is still well below its 52-week high at $55, and the starting yield on cost for the dividend is 4%. So I'll collect my 4% dividend while I wait for the extra 20% of equity to kick in over the next year or so. The company currently does face headwinds with its balance sheet. They only have about $200 million in cash with over $2 billion in liabilities, and the dividend payout ratio is pretty high at 83%. But if you look at everything with the whole COVID situation, I see the company performing much better and making much more profits after this economic slowdown is over. And I actually do think during the pandemic, companies are learning how to operate more leaner and more efficient. So I expect more profits to kick in and clean up the balance sheet and lower the dividend payout ratio. These things are all worth considering when looking at the stock and the risk associated with it. All right, the third stock I'm buying in the month of August is actually a basket of stocks into oil tankers. I'll put the 5 tankers I'm buying here. I'm doing more of an index-based approach into the sector because I'm bullish on the entire sector, and I think a lot of these stocks are very depressed. They have PE ratios of under 5, and for many of them, their market cap is actually smaller than the total market value of the company's assets. Like, for example, the company has more value in boats than they actually trade for on the stock exchange. So I'm trying to build a nice size position into oil tankers. If you look back at their past, they seem to be cyclical, and I believe these stocks also do have 10x type potential and pay nice dividends along the way. And with oil tankers being a very tough business to operate in the last decade, you're not having a lot of supply of ships go into the market. It actually takes 2 years to build an oil tanker ship. So when this market turns around, I think it'll turn around very fast, and these tankers will be able to charge premiums for storing oil on their ships because there will be such little supply in the market, and it'll take 2 years for the ships to actually meet demand. A lot of these stocks I'm buying, I follow the old Benjamin Graham quote, and that is that the intelligent investor is a realist who sells to optimists and buys from pessimists. And the fourth company I'm buying in the month of August is a company I wasn't expecting to buy, but after the earnings call on Friday, the stock tanked, and that is Illumina. Illumina, they are a life science gene sequencing company that I believe is going to be a huge part of revolutionizing healthcare as we know it. To me, it's very exciting to find investments that will not only provide great returns, but also it's just such a good idea and so much better for humanity as a whole. I feel this way when I invest in Tesla or LMND. It's such a better idea than what we currently have. And I really feel like gene sequencing will be fundamental to humans living much longer, healthier, happier lives. Because I think a lot of humans, they end up getting older and we get on medications that are trying to suppress issues within our system that really comes from flawed genomes within our system. So what genomics aims to do, it makes copies and replicas of your genomes, and the idea is to go back and repair those genomes back to their original form as your genomes alter throughout your life cycle. Now there's some wild ideas in the future that the mastery of gene sequencing will allow humans to live hundreds of years, and I really believe that's pretty cool. And while it's still a relatively small market, Illumina is the biggest player in the genomics sector. Illumina by far is the biggest player in the game because they have a $52 billion market cap, by far have the best balance sheet. They have over $3 billion on their balance sheet just in cash. So given their large cash position, I feel like they're sort of a safe bet as their cash position protects them from competitors coming in because they'll really be able to make more key acquisitions to help grow the company even faster. And I really think this is going to be $1 trillion sector in the future. This company only has a $50 billion market cap right now. But this company tanked this week on earnings. They dropped over like 10-20%. The company was nearly $400 a share. It was $400 a share and dropped all the way down to the low 340s, and that's where I bought it at. So I currently own 4 shares of Illumina at $347.79, and I'm just very excited about this investment moving forward. So guys, that wraps it up for this week. That is the 4 stocks I'm buying in my Robinhood portfolio. If you enjoyed the video, please again, just give it a thumbs up. That's all I ask if you find value in any of these videos that I make, and also subscribe to the channel with that notification bell on if you want to follow along on the rest of the journey. So that's all I have for this week, and I'll see you guys in my next one.